Welcome to Paint Ed. PCA provides painting contractors with connections they need to grow their business. To find out more and to become a member, visit pcapainted.org. Find more great content just like this on PCA Overdrive. A subscription to the platform is included with membership. For all you non-members out there, sign up for a free trial. PCA Overdrive is available on the App Store and Google Play. This episode is brought to you by Benjamin Moore and Sherwin-Williams.
If you don't need something, don't spend the money on it just for the tax write-off, okay? You're still spending money out of your pocket, and doing it to save 25 to 40% of it in taxes doesn't really make sense. Just at that point, pay the government their part. Save your 60 to 75% of that money and go on vacation with it. Welcome back to another episode where we talk about numbers and taxes. All right, I had to do something a little bit different. If this is your first episode, welcome to the Elite Business Advice podcast. My name is Chris Moore, the founder of Elite Business Advisors, your host for the podcast, and the self-admitted numbers nerd that loves to talk about finances, numbers, and taxes, although I force myself to talk about a lot of other things on this show. But we're at the end of 2025, almost. Does that sound crazy to you too, the way that it did me when I just said those words? I feel like I'm just getting comfortable saying 2025, and now 2026 already sounds like a crazy foreign word. And so many of you are about to embrace my favorite part of the year, where we just destroy our bodies. We got holiday parties coming, we got Thanksgiving, multiple feasts for some of you. All kinds of sweets and cookies and things that people gift you at Christmas time. And of course, I don't know about you, but you probably snack way more this time of year because our bodies go into that winter hibernation state. I don't know why I snack more when it's dark at 5:30 than in summertime when the sun's out. I'm sure there's some psychological research behind that. Not here for that. So because we're in that time of year, I figured it was time to do one of my favorite nerdy episodes that I like to do every year around this time. It's talking tax strategies to think about as we approach year end. And I always keep this fresh. I always come at it from some different angles. I always look back at my last couple years outlines and make sure I'm not missing anything important, but also like reformulate some of this. So feel free to like search back November, December, the end of each season, probably episodes 45 through 52. If you want like more info on this or see how we talked about stuff differently in previous years. But here's what I want to do today. I want to talk about some different tax strategies. I want to talk about how it applies differently to S-Corporations compared to regular LLCs and some nuances there. Also, what is an S-Corporation? And then most importantly, how do we prioritize this if your cash cushion isn't in abundance heading into wintertime when we don't want to deplete it just for tax purposes. So I hope it helps. Thanks for plugging in. This is the Elite Business Advice podcast. So I have two quick disclaimers as we kick off on this. Number one, this is the most important one. That's why I want to do it right now, because most people aren't going to tune in after this part in the episode, but you might drop off at some point. So I don't want to say this at the end. This is not legal tax advice. I don't know if I really have to say that or if I should say that. I'm sure our attorney would love for me to be saying that. But please discuss anything you're going to hear on here with your accountant or your CPA before you do it. And if you aren't sure who to talk to, whatever, just talk to whoever's signing their name on your tax return or whatever company is signing your tax return, right? We talk about that a lot. It's like, yeah, maybe you have somebody that does your bookkeeping, but if whoever's doing your tax return is like putting their name on everything that you're going to put as your expenses, right? And so we always want to make sure that they're good with what you're doing. And if they're not good with it, maybe have a conversation and see if that's the right person for you, depending on what we're talking about here. The second thing, everything I'm going to share here makes a lot more sense and is way more helpful if you've done tax planning with your accountant this fall. You should know kind of what you expect to owe at different levels of where your business is going to finish at this year. Okay. Usually how we do that with our clients or with some of our people is, we're projecting out, hey, where do we think we're going to finish the year at net income wise for our business, right? We're down into that 60-day stretch. We got all of our financials done through October. We're already able to project out like, hey, what is this going to look like? What do we think November is going to look like? December is going to look like? Income, expenses, where do we think we're going to finish at, right? And we run 3 different scenarios at 3 different levels that say, hey, at this net income, this is what you would owe to federal and state. At this net income, this is what you would owe, right? And we kind of give 3 scenarios and we can kind of see what makes sense, all right? Otherwise, if you haven't done that and you're sitting here and you're like, I don't know if we're going to owe $10,000 or $40,000 next year, what we're going to talk through probably isn't going to be a whole lot of value to you. But if you haven't done tax planning, 1, you might still be able to with your accountant. 2, it's okay. I would rather you get this education. So where 1, maybe some of this stuff is still helpful to think through, even if you don't know when you're in the dark. And number 2, for next year. Okay. You can never claim ignorance ever again. So here's what I want to kind of think through this in a couple different ways. And again, I try to put a different spin on this compared to previous years. Question number 1, I want you to ask yourself, do you expect to make more money next year compared to this year? Here's why I'm asking. Business grows in seasons. There's good seasons. There's seasons of which you're growing your business and I may not make more money, but I'm setting myself up for that next level of growth, right? There's kind of stair steps and plateaus, if you will, when it comes to top line revenue compared to bottom line income, okay? So as we're thinking about this, one of the first questions I want you to ask yourself is, are we going to make more money next year or are we more profitable probably this year? The reason why I want you to ask that is this is going to help us navigate what expenses we want to try to incur this year and what we might actually be better off saving for next year. So let me explain. If next year you plan to elect to become an S-Corporation, you are not this year. It's pretty much too late to do it for 2025, but we can make that election to start in 2026. Quick rule of thumb on this, and I'm not going to go down the weeds on what an S-Corporation is, but just quick rule of thumb. If your net income is $60,000 to $70,000 or more in 2025, typically you want to think about filing as an S-Corporation because you will start saving money on taxes at that level of income and beyond. Some states are different. I know Tennessee has some nuanced things where it's not as beneficial in different parts. So again, just talk to your CPA or accountant. Should I think about this? Should I not? There's a lot more to it than that. I'm not going to get into what's different and whatnot. Just understand the concept. There's some different little nuances we'll talk about in this episode on how you kind of operate your business a little bit differently. It completely separates your business and your personal stuff. That's all you need to know. But if you're looking at this and you say, hey, next year I'm going to file as an S-Corporation, then you can expect to pay less in taxes next year, and you're going to probably incur more in taxes this year, right? So what I would say in that case is we want to try to take as many tax deductions as we can here in 2025 because we already know we're going to do a new strategy next year that's going to expect to lower our taxable income next year, right? Another thing. If you're looking at this and you're saying, hey, next year we plan to buy 2 vehicles for the business because we're going to hire a project manager and an estimator. And so we need to buy 2 vehicles. So we'll have the depreciation on those 2 purchases next year. Then we may want to figure out how we do some other expenses this year, knowing that we're going to have some built-in tax incentives next year, right? Maybe you're looking at this and this year was kind of rough profitability wise, but you expect next year to be a lot more fruitful. Or, hey, we had a good year this year, but we're actually expecting to be even more profitable next year. Then we want to figure out where's our comfort level of what taxes we're going to pay this year. And then how do we actually maybe start focusing on the things that we want to start using for write-offs next year instead of this year if we expect we're going to make more money next year, right? I know for us personally, a big thing that's kind of shifted is, I don't know if I've shared this on an episode, but my wife cut back to part-time at her job. She works 3 days a week now. So, we're going to have, it just happened in September, so we're only going to see a few months of it this year, but next year, we're going to have 40% less income from her job in our, income next year, right? And so that kind of plays into my tax strategies as I look at our company and us personally and what we're doing this year compared to next year and a lot of other things that we're kind of bouncing up against as well. So look at that. What do we expect this year compared to next year? What's that going to look like? One of the easy things that you can do that I always recommend, this is like the easy low-hanging fruit, is income and expense shifting. And what I mean by that is, most of you guys listening to this are going to be kind of on a cash basis, right? So your profit and loss is January 1 through December 31st, and it's when money comes in or out of your account is when we record the income or expenses. It's not when you invoice. It's not when you receive a bill. It's literally in, out. And in that case, then anything you purchase by the end of December 31st is a tax write-off for this calendar year. Anything you purchase, after the first of the year goes towards next year, right? And so there's a lot of things you can do here, and I'll get into kind of another question to ask yourself here in a second, but there's a lot of things you can do that you can purchase at the very end of December this year that will lower your taxable income this year. And then you have it for next year, right? So one thing that a lot of our clients are doing is we just announced, and we did this strategically for you guys. 2 weeks ago, we announced the Elite Business Retreat, July 22nd through 24th here in St. Louis again next year. I know that's like 7 months away, but you're able to buy your tickets for that retreat now, by the end of the year. Take that write-off here in 2025, even though you're not going to get the benefits of it until next year, right? Same thing with PCA Expo. I'm about to book my flights and our hotel for PCA Expo now, because we're going to take that as a tax write-off this year, even though we're not going to Orlando until February 16th of next year, right? So what are the things that we can purchase now that we were already going to spend money on next year anyways? And again, hopefully the retreat for you is a no-brainer there. Shameless plug for that. Not sorry. But another big thing, especially if cash isn't really abundant, and I'll get into that here in just one second. But another thing is, what can you purchase, again, very end of December, that you were going to buy anyways in January? Is it we've had some clients go to Sherwin-Williams and buy like $5,000 or $6,000 worth of paint, and they buy the products they know they're going to use in January, February. So it's like, they're shifting that up. They take the tax write-off now, but then they're not spending the cash flow on it in January, February, right? So as long as you've got a little bit of cash to weather that purchase right now, you're going to recoup that money pretty quickly, right? So think about that, right? Is there any jobs you do right around Christmas that you accidentally forget to invoice until January 2nd? Accidentally forget to. I hope you can read between the lines on that. So there's different things you can do, just simple deferring income, accelerating expenses forward. What are some things we can do with that to navigate that? Is it, again, easy, low-hanging fruit place to start. The second question I want you to ask yourself, and these are really the only two questions I've got here, but this kind of dictates what makes sense for you to do and what doesn't. Another question I would want you to ask is, do you have cash to spend, or is our cash cushion heading into wintertime a little bit tight right now? It's a big conversation we've been having with our clients the last couple of months. What's our cash cushion? We've had goals set by November 1, December 1, where we want them to be at, what will help them successfully navigate, a potentially slower winter, what we feel good about, we can sleep good at night. And then there's hey, it would also be great if you have, $20,000 or $25,000 for any tax write-off stuff we want to do. Again, even if it's buying paint in bulk for, and buying your retreat tickets and flights and stuff, whatever. So if you have some money that you can afford to spend as part of your cushion, again, the other things we're looking at this is what's the cushion, but also how much work do we have scheduled for December, January, February, right? Do we feel good? Do we feel secure about it? We feel good about spending the money. So if you've got some money that you can afford to spend without putting yourself in a cash bind should things slow down in the next 90 days, what I would say is, a couple things you can think about is possibly some sort of a retirement contribution through the business potentially. There's different ones out there. Some of them, needs to be set up by certain dates. But if you, have a SEP IRA, depending on how your business is set up, you can make a contribution to that. Other ones out there, again, I won't get into the nuance. Talk to your financial advisor, see what your options are there. Some other things, can you pay your kids? This is going to be a year-round thing, but I'll bring it up now, especially as we're heading into some breaks during the year. I'm a huge fan of taking care of paying your kids as part of a tax strategy. Now, The thing is, it has to be legitimate, it has to be documented. You need to have proof of things, and you need to pay them a reasonable wage for the tasks that they're doing. Okay. Case in point, I can't pay our 2-year-old to be our webmaster and build out our website for us. See what I'm saying here? Like, I would love to, I mean, I can do it, I guess. I just hope I don't ever get audited, right? So I'm not going to do it. Just to clarify in case the IRS ever hears this. Like, we have to do what's reasonable, what makes sense, right? So if you have small kids, like, I'm itching for the day that I can really start to justify some other things, and I can get creative, and, do things on our social media and like highlight them. And like, there can be some small things like that, but like, I'm itching for the day when they're like 5, 6, 7 years old, where I can start like really utilizing that and justifying it. Okay. So that's a great thing I recommend throughout the year. If you have teenage kids or, whatever, have them doing door hangers, have them prep door hangers, have them do administrative stuff, like clean the office, like organize your computer, like whatever. There's so many things that they can do that you can legitimately pay them for, which is a tax write-off for the business. That money goes into their account. There's a couple nuances here if you're an S-Corporation or not. I won't go into it, but like, you can pay them up to the standard deduction, pretty much income tax free to them, which I think's $12,000 to $13,000 this year. So you can pretty much pay your kids where they don't pay taxes on it, and it's money coming out of your business. And all of a sudden now your kids are paying for their cheer camp and sports camps and new hockey gear and whatever, right? So again, it's a mentality shift that you can make as a business owner, that instead of you paying for that stuff personally, your kids pay for it now, and they earn money from your business to pay for those things. And now you're taking more money out of your business tax-free, legitimately. It's a win-win. Employee bonuses, this can be a great thing, whether it's profit share, whether it's Christmas bonuses, whatever. That's obviously another thing you can do. I hesitate to say this because I don't want anybody to go crazy with it, but like, employee advances can be something else as well. Something to think about. If you have some employees that you really like, you trust, they're going to stay here, and you want to give them a little bit of a bonus or an advance here at the end of the year, and then spread that repayment back over like 3 or 6 paychecks next year, if that's helpful for them at Christmas time. Again, tax write-off for you now. Again, just moving up that expense. So again, I would tread very cautiously on that, just because you don't want to give somebody an advance and then them leave at some point in the next month. But again, something that has worked well for people and a strategic approach. So if you don't have money to spend, which is fine, it's a reality, it's okay, I'm not shaming you by any means, then what we need to do is we need to get a little bit more strategic about this. What I mean by strategic is we need to figure out how we can have some tax write-offs if you need them this year to lower your taxable income, but not in a way that's going to just take cash directly out of your business, right? Or we're throwing it on a line of credit or debt. I wouldn't really recommend leaning into debt just for tax write-off things. Maybe a line of credit if it's for a really short season and you've got some money coming in January to cover it. Other than that, I don't know that it's worth taking on a 9 or 10% interest to spend 10 grand to save tax. Like, I just don't know that it really makes sense. You can do some math on that and see case by case what you're dealing with. But so a couple things I would think about on this is vehicle purchases. I don't love it. If you don't need it, don't do it. But like, it's something to think about. You could utilize it. The thing I like about it is if you do need a vehicle, you need a trailer, you need something that we can depreciate this year, you stretch out that cash flow, but you get the full write-off now, right? So if you buy a $30,000, van or company truck or whatever, you might only pay, throwing out random numbers here, don't think into this too much, but like $600 or $700 a month. Granted, you're going to do that for the next 5 or 6 years, but you get to take that full $30,000 tax write-off this year, right? So it's like you don't have to pay the 30 grand out of pocket this year, but you get the tax write-off for the depreciation in 1 year. Again, talk to your accountant about that to make sure what you're purchasing qualifies, but it would be something to think about, again, in a pinch. We've had some clients, again, debt repayments, maybe paid themselves a lot throughout the year. They had pretty good profitable years, but they don't have a lot of cash to show for it for a variety of reasons. And we need to lean into something like this just to kind of get through the year so they don't get hammered with taxes next springtime, and think about it. So another thing you can do, and I'm going to get into like some of these actual reimbursements here in a second, but if you don't have a lot of cash, the next couple things I'm going to talk about, you can kind of reclassify your draws or your distributions as the owner as these things. So talk to your accountant through it, and I'll explain what I mean by that here in just a second. But you can do that, or instead of taking a draw, just take the same amount of money but classify it as mileage reimbursement, and that way you're not taking your draw plus more money out of the business, if that makes sense. But a couple of things to think about. Mileage reimbursement. This is huge for people. If you have vehicles that you own personally, so the business does not own them, I always say who's on the title and who's on the loan for it. Okay. If it's owned personally and it's driven for business, you get reimbursed, or you get to write off 70 cents per mile driven for the entire calendar year. And I know, because I've been in your shoes before, a lot of you guys are driving 10 to 20 to 30,000 miles a year all over God's green earth, doing estimates, job site visits, everything, right? 70 cents per mile. I've seen plenty of people have a $15,000 legitimate tax deduction just from their mileage. Okay. Now, one thing to think about, you need to have a daily log of how many miles you drove and where you went. Okay. So you can't just say, oh, I drove 25,000 miles. My odometer was this in January. It's this now. Like, no, you need to have proof. Okay. This is something the IRS can easily audit you for and bust you for. And I'd hate for you to lose a $15,000 deduction because you just faked it. Okay. If you're an LLC, you're not an S-Corporation, you can just take this amount as a deduction on your taxes. So you don't have to have the money. You just take it as a deduction at the end of the year. Super easy and simple. If you are an S-Corporation, you have to physically reimburse yourself for the amount of what your mileage was. Okay. So you have to reimburse yourself by December 31st for this. Again, you can reclassify some of your draws throughout the year towards it, and then just maybe have a small payment to settle up on that exact amount at the end of the year. But again, talk to your accountant through that situation here, but understand 70 cents per mile driven on vehicles owned personally for the business. Utilize that, but make it legit as always. Another thing, business use of home. You can write off home office space used for the business. Again, S corporations have to physically reimburse for this. It's a whole thing called an accountable plan. I won't get into on this episode, chat GPT it. But or talk to your accountant, even better actually. Whoever's signing off on your tax return, as I said. But you can write off home office space used for your business. So again, LLCs can just take that on their tax return. S corporations have to actually reimburse. Again, if cash is tight, reclassify draws, or take your current draws as that and let your bookkeeper know. Another thing to think about, it's called the Augusta Rule. You can legitimately rent out your home up to 14 days per year to anybody, but to your business as something as well. Now, this couple keywords here. Number one, legitimately. Number two, documentation is key. You need to have a record of this. You need to have a rental agreement. You need to have pictures of what you used your house for. So was it an employee appreciation, customer appreciation? Was it a team meeting, a board of advisors meeting? What did you do? Who was there? It's got to be legitimate. So documentation is key. Do not just fake renting your house out to your business 13 days this year and then just hope for the best, right? You also have to rent it at a market rate. So what's a comparable rate on Airbnb or VRBO for a house like yours in your market during that time period, right? You can't just say, oh, I rented out my house to myself for $5,000 a night when the average market rate is $450 a night, okay? So again, it's got to be legitimate. Don't just fake this, but it is something else to think about. And again, even if you're not going to do it between now and the end of the year, how can you think about this as you head into next year? Maybe you have a monthly, if you have a pool at your house, for 6 months out of the year, you have a monthly pool party for your team, and there's 6 to 7 nights you can rent to yourself, again, at a market rate. So on everything that I just talked about, let me be very clear. If you don't need something, don't spend the money on it just for the tax write-off, okay? You're still spending money out of your pocket, and doing it to save 25 to 40% of it in taxes doesn't really make sense. Just at that point, pay the government their part, save your 60 to 75% of that money, and go on vacation with it. Okay? If you're going to do something that you're going to spend $10,000 on, something that you don't need, again, you're only going to probably save $2,500 to $4,000 in taxes out of that $10,000. So it means you're still spending $6,500 to, $6,000 to $7,500 that you could have just saved if you don't need something, right? So as we talk about this, I'm all for tax strategies. I'm all for lowering your taxable income, doing it legitimately, doing it legally, taking advantage of the IRS tax code. But don't spend money on things you don't need. If you don't need another sprayer, don't go spend $4,000 on another sprayer just to write it off. For the love of God, just don't do it, okay? Last thing, as I wrap this up, I want to hit on a couple quick updates on things to think about that have changed thanks to one of the legislation pieces that got passed this summer. Two things that happened this year, one that's good to keep in mind for next year. So number one, if you itemize on your taxes, state and local taxes are no longer capped at $10,000. It's now at $40,000. So if you have really high property taxes, you have different things. Again, this is going to apply personally, not for the business. You're going to get a bigger deduction this year than you did last year. So look into what qualifies for state and local taxes. SALT taxes is what you may hear them called. So look into that, see if you're itemizing. If you don't itemize, either way, whether you do or you don't, a new thing this year is you get a personal deduction for any auto loan interest up to $10,000 if you purchased a brand new vehicle, not used, not a lease. If you purchased a new vehicle after January 1st of this year, and the final assembly of the vehicle was in the U.S. So if you bought a new vehicle, after January 1st, and the final assembly was here in the U.S., you can deduct up to $10,000 of your auto loan interest, whatever you're paying on it this year. Hopefully you're not paying that much, but if you are, I guess it's a good consolation prize. But it's a tax deduction now. Again, this is a personal thing. So think about this. If you bought a new vehicle after this year that you bought personally, now you get to deduct up to $10,000 in interest on your taxes. Plus, then you get to reimburse yourself for 70 cents per mile driven. Something to think about. The last thing, starting in 2026, you can actually contribute as an employer up to $2,500 to a new, what they're called, Trump accounts. I'm not getting political, good or bad, just that's what they're called. For each of your employees' kids, that is a tax write-off for you, and it's not taxable income for the employee. Now, we can't do this year because the accounts can't be opened until July of 2026, but something to keep in mind for next year is another tax advantageous thing to budget for. Or if we're having the conversation about tax write-offs this year compared to next year, understand that next year there's some pretty cool things like that you can do for benefits for your employees where you can contribute up to $2,500. I believe it is for each individual kid they have. I know there's a $5,000 limit. I think it's per kid, not per family. Still a few nuances that we're waiting to get clarifications on, but something to think about. So I hope that was helpful. I hope you are able to take some stuff away from this and utilize it. I hope you're able to get your taxes where you want to be at. And again, if it's a little bit too late to do some of the stuff we talked about this year, maybe again, you don't have the cash, you haven't done the planning, use this as education. Go put a reminder in your calendar right now for middle of September next year to do tax planning, and then to revisit this episode in October, November when you get those results back and figure out what you can do to make you in control of what you're going to owe the government next springtime. Thanks for plugging into this week's episode. I hope you're able to take a few nuggets away from it to implement into your business. Remember, knowledge without implementation is useless. If you're curious about what we do and how we help painting contractors all over North America, schedule a free business analysis meeting with us at www.elitebusinessadvisors.com. Our entire team of advisors have ran and managed painting companies just like myself and are here to help support you on your journey. We have packages available for contractors at every stage of business, from flying solo and just starting out, all the way to multi-million-dollar businesses. And lastly, if you loved this episode, please leave us a rating and a review. It helps others on the platform find our podcast, and it could be the best blessing that's ever happened to them thanks to you. Thanks for plugging in, and we'll see you back for next week's episode.
Paint Ed podcasts are produced by the Painting Contractors Association and are made possible by members and industry partners. To find out more about the upcoming educational opportunities or for more information about joining the PCA, visit pcapainted.org.